Welcome to the Deep Dive. We're the show where we take your sources and really distill them down into the most important nuggets of knowledge and insight. And today we're asking a pretty big question, I think. Is Howmet Aerospace, that's ticker HWM, is it really the silent, indispensable engine powering the whole aerospace industry's climb? Or, is its recent really impressive stock performance just reflecting expectations that are already, well, sky high? Maybe not much room left. So, our mission today is to take a deep dive into your sources on Howmet Aerospace. We're looking at the business, the management, the financials, its market position, potential risks, all of it. We're basically hunting for evidence of, a real enduring competitive advantage, something the market might still be underappreciating. Just for context, as of August 22nd, 2025, Howmet shares closed at $171. And hey, if you like these deep dives, remember to like and subscribe to the Stock Analytics AI channel. Our $4.99 a month members, they get priority access to these S&P 500 deep dives, and we're covering all of them over the next few months, so members get first dibs. Plus, if you want a specific stock cover, just drop us a super thanks for a one-off request. Okay, so we'll tackle Howmet in two main parts today, exploring 7 distinct chapters.
Yeah, and what's really fascinating here, I think, is Howmet's position. It's right at this nexus of part, like record aircraft backlogs, surging global travel, and even these heightened geopolitical tensions. I mean, those are all really powerful tailwinds. But the question, like you said, is whether the market fully gets just how critical Howmet's role is in all of this. So yeah, our goal is to equip you, the listener, with a really clear understanding of their competitive landscape and maybe what they're intrinsically worth.
All right, let's pull back the curtain then. Let's see how deep these roots go. We'll kick off with part 1 that covers our first 3 chapters. We'll dissect what Howmet actually does, who's running the show, and what the numbers are telling us. #tag chapter 1, understanding the Howmet Aerospace machine. Okay, so first things first, let's get a really clear picture of Howmet's core business and, its place in the market. We're not talking about generic parts here. Howmet builds mission critical components, the organs of flight, you could say. They're a premier global provider of these advanced, high performance engineered solutions. Think of it like this. Without their parts, a jet engine literally cannot start. They are indispensable.
Absolutely indispensable for safe, efficient operation of engines, airframes, even those big commercial trucks.
So what are they actually making? Let's look at the segments. First up, engine products. Howmet is a world leader here. Investment cast airfoils, those incredibly complex blades and vanes right in the heart of a jet engine.
And these aren't just shape metal. They operate in conditions hotter than their own melting point. That requires proprietary coatings, decades of material science. It's really advanced stuff.
Right. They can supply over 90% of the structural and rotating parts in a modern aero engine. That's huge. Then you've got fastening systems. Again, not your hardware store nuts and bolts.
No, definitely not. These are highly engineered fasteners, latches, bearings designed for aircraft assembly. They handle extreme stress, vibration, and crucially, minimize weight, especially important for modern composite airframes.
Then there's engineered structures. This is about large, complex airframe parts. Think forged bulkheads, wing components, often made from titanium or aluminum.
Big critical pieces.
And finally, forged wheels. They're a global leader here with the Alco Wheels brand, iconic name.
Yep, for heavy-duty trucks mainly. Lighter, stronger, more corrosion-resistant than steel. Helps with fuel efficiency and payload.
So these aren't just off-the-shelf parts.
Not at all. They are the result, really, of decades of material science, process innovation. And that deep specialization in aerospace, combined with some strategic diversification, gives them a really unique, defensible market position.
And speaking of market position, they're dominant, leading across their product lines. Global footprint, 58 locations, 20 countries, almost 24,000 employees. There's a mission-critical Tier 1 supplier to all the big names: Boeing, Airbus, Lockheed Martin, GE Aerospace, RTX, Safran.
And these aren't just casual relationships, often locked in with long-term agreements, LTAs, sometimes 5, 10 years or even more.
So their value proposition is basically unparalleled performance, reliability, efficiency, driven by differentiated tech backed by, nearly 1,300 patents, plus 80 years of know-how.
Exactly, and that translates into real benefits for customers. Lower carbon footprint, lower operating costs, better safety, better performance, tangible stuff.
Okay, so with such a strong base, the big question is growth, right? How does this translate into future growth? Are they just riding a strong market wave, or are they actively positioning themselves?
Well, the industry analysis definitely points to some serious tailwinds. We're in what people are calling an aerospace supercycle.
Yeah, global air travel projected over 5 billion passengers in 2025. That means fleet expansion, maybe 38,000 aircraft by 2035.
And those unprecedented aircraft backlogs you mentioned, over 17,000 jets on order for Boeing and Airbus.
Right. That provides incredible long-term visibility, years of predictable demand.
And here's something really critical, the MRO supercycle. MRO is maintenance, repair, and overhaul.
Ah, yes. This is key because new planes aren't being built fast enough,
Exactly, so older planes are flying longer, flying harder.
which means more maintenance, more repairs, more overhauls. It's a huge tailwind for Howmet's aftermarket business. High margin, too.
Right, boosting that MRO market to, what, $119 billion projected for 2025 alone? Huge number. Plus, you've got elevated defense spending, geopolitical stuff, driving demand for military aircraft like the F-35. Howmet's a key supplier there, too.
And they're leveraging new tech AI for predictive maintenance, 3D printing, digital tools.
So yeah, these aren't just like fleeting trends. They are powerful forces converging, creating this really robust, durable demand environment. That MRO cycle especially highlights how essential Howmet's parts are. They keep older planes flying safely.
Now, what about competition? It's got to be intense.
Oh, absolutely. You've got diversified giants like GE Aerospace, RTX, specialists like Parker Hannifin, TransDigm.
But Howmet's scale and that technological breadth seem to set them apart.
Yeah, competition really boils down to tech, quality, reliability, service, and price.
And they operate in one of the most stringent regulatory environments globally, FAA, EASA.
Which means constant, substantial investment in quality control, documentation, traceability. Howmet's long history here is a massive asset, almost a barrier in itself.
So, this sounds like a fortress. But are there chinks in the armor? Let's talk barriers to entry and their competitive advantage. The barriers seem extreme. You need billions, years to build these facilities.
And the proprietary tech, those 1,300 patents, decades of know-how.
Plus the lengthy, costly qualification cycles with the big OEMs and regulators. You can't just jump in.
And those deeply entrenched customer relationships, with 70% of aerospace revenue under those long-term contracts, locks out competitors.
Okay, so what about the competitive advantages themselves? First, brand strength. Howmet, Alco Wheels. These names mean quality, precision.
But customers just aren't willing to risk switching suppliers for these critical life-or-death components.
Second, cost advantages and economies of scale. That global footprint, high volumes, optimized processes, buying power, it all helps margins.
Definitely supports strong profit margins.
Third, and maybe the biggest, network effects and switching costs.
Exceptionally high. It can take years, millions of dollars for a customer to re-qualify a new supplier for these parts.
So that creates a really resilient customer base, gives them pricing power, long-term revenue visibility.
Exactly. And finally, their unique assets and capabilities, their mastery of material science, those differentiated process technologies, making parts perform flawlessly in environments hotter than metal's melting point. That's protected by decades of R&D and IP. It's hard to replicate.
Hashtag check chapter 2, evaluating the captains of the ship.
All right, so we have a clear picture of a really formidable business. Now, let's talk about the people in charge, the ones steering this impressive ship. Leading the way is Executive Chairman and CEO John C. Plant. He's got extensive leadership experience, was CEO of TRW Automotive, knows complex global operations.
And crucially, he orchestrated that successful separation from Arconic back in 2020. That unlocked a lot of shareholder value. It wasn't easy.
Right. And the broader leadership team seems experienced too, average tenure over 5 years. What about transparency and ethics? Seems like a strong commitment there. Yeah, they've got the public code of conduct, anti-corruption policy, human rights policy, even an integrity line for confidential reporting. Seems standard but important.
And they are pretty transparent in earnings calls, giving guidance, even down to assumptions about OEM build rates.
All good signs. But, you know, a really critical aspect for me is capital allocation. How effectively do they invest the company's money? That's a true test.
Good point. Their strategy seems disciplined. They've mostly avoided big M&A since the 2020 split. The focus is clearly on organic growth, reinvesting in their most profitable, tech-differentiated core businesses.
Their 2023 annual report even says they prioritize major differentiated products for allocation of investments. Pretty explicit.
And you see that in the numbers. CapEx went up quite a bit, from around $221 million in 23 to $321 million in 24, mostly expanding capacity for high-demand stuff like advanced airfoils. And they're guiding higher again for 2025.
And that feeds into what Plant calls the capacity as a weapon strategy.
Right. Using their constrained, specialized capacity in a high-demand market to argue for premium pricing in exchange for guaranteed supply.
Yeah, that's been a key driver of their margin expansion. Clever strategy.
And beyond reinvesting, they're definitely committed to returning capital to shareholders. The sheer buyback history is aggressive. $500 million in 2024. Another $400 million just in the first 7 months of 2025.
Wow. And still $1.8 billion authorized. That consistently reduces the share count, boosts EPS.
And the dividend policy shows real confidence, rapid growth. They reestablished it after the 2020 split, raised it 25% in Q1 25, another 20% in Q3 25.
That's a 100% increase year over year and 4 straight years of increases. Impressive.
It signals confidence from management.
Absolutely. This whole balanced approach, reinvestment in core, aggressive buybacks, growing dividends, it really points to a high-quality management team focused on long-term per-share value, a virtuous cycle.
But does it raise any concerns? Like, are they potentially underinvesting somewhere else, sacrificing future potential for current returns?
That's always the question to ask with aggressive capital return programs. But let's look at return on invested capital, ROIC. That tells us how well their investments are actually performing.
Okay, so ROIC, how effectively they turn capital into profit. What's the story there?
It's strong, very strong. TTM ROIC is somewhere between 13.87% and 16.74%, significantly above their cost of capital.
And crucially, it's trending up.
Exactly. Improved from around 8% in 2022 to over 10.5% in 2023 to over 15% in 2024. That's direct evidence their investments are working, their operational discipline is paying off, every dollar invested is generating really impressive returns.
Hashtag Chapter 3, a look under the financial hood.
Okay, time for the numbers. Let's pull back that curtain on Howmet's financial performance and eventually its valuation. First off, scale. Market cap around $69.3 billion. Definitely large cap territory, significant presence. Revenue growth trends show real resilience, acceleration after 2020.
Yeah, impressive double-digit year-over-year growth since then. Hit $7.43 billion in 2024. And the momentum's continuing. TTM revenue is $7.72 billion, and their 2025 guidance is even higher, targeting over $8 billion.
Growth is solid. What about profitability? Margins?
Also expanding nicely, shows good cost control, efficiency, and that pricing power we talked about. TTM gross margin, healthy 32.5%. Operating margin, really remarkable upward trend.
Yeah, from 18% in 2023 to over 22% in 2024, now almost 24% TTM. Record highs in Q2 25 at over 25%.
And TTM net profit margin, strong, 18%.
That consistent margin expansion, especially in this kind of capital-intensive industry, really highlights their differentiation. They can command value.
Now, for value investors, free cash flow is king, right? The lifeblood.
Absolutely. How's Howmet doing there?
They're a powerful generator. Record FCF in consecutive years. $540 million in 22, $682 million in 23, almost $1 billion, $977 million in 2024.
Wow. Consistent.
9 straight quarters of positive FCF, and they're guiding to exceed $1 billion in 2025. High FCF conversion rate, too, around 88%. Close to their 90% target.
Powerful cash generation. Okay, what about financial stability, debt, earnings consistency?
Earnings consistency shows growing power. Net income has really taken off. $467 million in 2022, jumped to $763 million in 23, then $1.15 billion in 24. TTM is $1.4 billion. Substantial growth.
Nice bottom line growth.
Debt. Very manageable.
Yeah.
Debt to equity ratio is just 0.65, down significantly from 5 years ago.
That's really healthy for a cyclical industry. Gives them flexibility, resilience.
Right. Total debt around $3.4 billion versus equity of $5 billion. They've got an investment-grade credit rating, too, BBB plus from Fitch.
Good shape on the balance sheet. Liquidity. Current ratio.
Robust, 2.31. Plenty of current assets to cover immediate obligations, low short-term risk.
Okay. And we already touched on the dividend stability and growth track record there. Conservative payout ratio, too.
Yeah, only 11.7%. Lots of room for future increases if they choose. So the financials paint a really compelling picture. Strength, growth, discipline. But like we said, even the best business can be a poor investment if the price is wrong. How is the market valuing this?
Let's look at relative valuation first. Price to earnings.
The TTM PE is around 50.7. Now, that is high compared to its own 10-year average of about 36.6.
Okay, how about versus peers or the industry?
Higher than some direct peers like GE or RTX, but actually considerably lower than the broader aerospace and defense industry average, which is way up at 74.6.
So the market clearly has high expectations baked in, but maybe not as high as the overall sector. Still feels elevated, though.
It does suggest high expectations for future earnings growth.
Right, and relative valuation only gives us context. It doesn't tell us what the business is fundamentally worth. For that, we need to think about intrinsic value.
Exactly. And the classic way to approach that is a discounted cash flow model, or DCF.
The basic idea being a business is worth the sum of its future cash flows, discounted back to today's value.
Right. So we ran an educational DCF model. What did it suggest?
Well, based on assumptions like FCF growth aligning with analyst DPS estimates for the next 5 years, that's around 21-24% annually, then tapering to a 2.5% perpetual growth, and using a discount rate, or WACC, of 8.5%. Our model suggests an intrinsic value range of roughly $185 to $205 per share.
Okay, $185 to $205. We'll come back to that. So that brings us to the halfway point. We've got a solid handle on the business management financials. Now let's pivot to part 2, chapters 4 through 7. We'll look at market mood, ownership, risks, and then tie it all together in the conclusion. Hashtag tag chapter 4, gauging the market's mood. Beyond the fundamentals, market sentiment is huge. So what's the pulse on Wall Street regarding Howmet?
Overwhelmingly positive, actually. The consensus rating is moderate buy or buy. Get this, 18 out of 24 brokerage firms rated a strong buy. That's significant conviction.
Yeah, and price targets.
The average 12-month target range is somewhere between $172 and $207. And you've got influential firms like Bernstein, BofA, Vertical Research, all raising their targets recently. Bullish sentiment.
Okay, so analysts are positive. What about recent news flow, media tone?
Also broadly positive. Lots of focus on the record financials, the earnings beats, raised guidance, strong cash flow, shareholder returns, all the good stuff we discussed.
But didn't you mention something interesting after their last earnings report?
Yeah, the sell the news paradox. After a stellar Q2 2025 report, they beat everything, raised guidance again, the stock actually dropped nearly 7% pre-market.
Interesting. What does that suggest?
It suggests expectations were incredibly high. The market had already priced in not just a great quarter, but maybe even perfection, especially after the stock ran up like 80% in the prior year.
So a high bar to clear. Even beating estimates wasn't enough.
Exactly. It indicates a lot of future success is already reflected in the current price.
Okay, what about other market indicators? Short interest.
Pretty low. Only about 3.19% of the float as of late July 2025, and it decreased from the month before. Suggests waning bearish sentiment. Not many betting against it.
And technically, price versus moving averages.
Well, the current price, $171, is actually trading a bit below its 50-day moving average, which is around $180.
Okay. Short-term pullback or consolidation, maybe.
Could be, but it's significantly above its 200-day moving average, which is down in the 141 and 154 range.
So that indicates a strong, sustained long-term uptrend is still intact.
Precisely. Strong long-term, maybe some short-term digestion of gains.
Hashtag tag chapter 5, ownership structure. All right, let's talk about who actually owns Howmet. What does the ownership structure tell us about investor confidence?
It's heavily concentrated with institutional investors. Over 95% owned by mutual funds, pension funds, asset managers.
That usually indicates strong confidence from the so-called smart money, right?
Generally, yes. The top 25 shareholders control nearly 68% of the company.
Who are the biggest holders?
Led by the passive giants, Vanguard with 12%, BlackRock with 11.4%. Also big active managers like JP Morgan Asset Management. And being in the S&P 500 means index funds provide stable, somewhat price-insensitive demand too.
What about insiders? Management ownership?
Relatively low, actually. Around 1.1% of shares outstanding.
And have they been buying or selling?
Net sales have outweighed purchases over the last 12 months, about 708,000 net shares disposed of. But context is important here. CEO John Plant had a large sale, 800,000 shares, back in May 2025. But it was reported as his first open market sale ever for estate planning and diversification. He still holds over 3.1 million shares. So significant skin in the game remains.
Right, so not necessarily a red flag, especially after big stock gains, but worth noting.
Always worth noting. But you need the context.
So that high institutional ownership concentration, benefits and risks.
Benefit is high conviction from sophisticated investors, potentially stabilizing. Risk is that if sentiment changes or a few of those mega funds decide to reallocate, it could cause significant selling pressure. Top 10 hold over 50%.
Hashtag chapter 6. Risk assessment. SWOT analysis. Okay, no deep dive is complete without looking squarely at the risks and challenges. Let's run Howmet through a SWOT analysis. Strengths, weaknesses, opportunities, threats. Let's start with strengths. We've covered a lot of these.
Right. Market leadership, that tech moat with the patents, robust financials growth, margins, FCF, disciplined capital allocation, those entrenched customer relationships with high switching costs, big strengths.
Okay, weaknesses. Internal limitations.
Well, the big one is cyclical end market exposure. Aerospace and commercial transport go through cycles. Customer concentration is another heavy reliance on Boeing, Airbus, a few others. If they sneeze, how it could catch a cold.
And it's a high capital intensity business, requires continuous big investments in tech and capacity.
Definitely a weakness, if not managed well, but their ROIC suggests they are managing it well.
Fair point. Now, opportunities, future potential.
The sustained aerospace upcycle is the main one. Air travel, fleet expansion, defense modernization, geopolitical tailwinds benefiting programs like the F-35.
Growth in adjacent markets, too, like commercial space, industrial gas turbines, maybe for data centers.
Yeah, potential there. Diversification opportunities.
All right, finally, threats, external challenges.
Intense competition's always there. Supply chain vulnerability, raw materials, lower-tier suppliers, that's a big one, industry-wide. And cybersecurity risks. They're a high-value target dealing with critical infrastructure tech.
Many of those threats seem systemic to the industry, though.
They are. But Howmet's strong balance sheet and pricing power probably give them more insulation than smaller competitors.
How about macro factors? Inflation, interest rates.
Inflation increases costs, materials, energy, labor. Howmet seems able to pass costs on due to their position, but maybe with a lag, which could temporarily squeeze margins.
And higher interest rates could dampen airline demand for new planes?
Potentially, yes. But Howmet's own low debt makes it less vulnerable to its borrowing costs increasing, more resilient there.
And specific geopolitics, like those U.S. tariffs from 2025.
Well, there was actually a positive development there. The U.S. and EU agreed on a zero-for-zero tariff policy for aircraft and parts in summer 2025.
Ah, okay, so that de-risked a core part of the business.
Yes, but there's still risk from potential broad-based tariffs on raw materials like steel and aluminum that could still raise input costs. Their ability to pass those on remains key.
Hashtag Tech Chapter 7. Conclusion.
Okay, we've covered a lot of ground, journeyed through the intricate world of Howmet Aerospace. Let's bring it all together now. Summarize the findings. The bull case first. What are the key bullish points?
Well, it's pretty compelling. Technologically superior, indispensable supplier, widening economic moat. They're operating right at the heart of this multi-year aerospace, supercycle backlogs, MRO, defense spending.
Expert management, exceptional capital allocators, fortress balance sheet, high return organic growth focus.
Aggressive capital, return those buybacks. The rapidly growing dividend, that capacity as a weapon strategy driving margin expansion, and the high rising ROIC confirming value creation. It's a quality story.
Okay, sounds great. Now the bear case. Key bearish points.
The main one is probably valuation. That high PE multiple relative to history suggests the market has priced in a lot of future success. Little margin for error or safety.
Vulnerability to those cyclical markets, aerospace, transportation. A global downturn would hurt.
Customer concentration risk. Issues at Boeing or Airbus or strategic shifts there could have a big impact. And those remaining raw material tariff risks, potential supply chain disruptions, still out there.
So it really raises this question. When a company shows such fundamental strength, how do you square that with a market that seems to already anticipate perfection?
Exactly. Is there a point where the quality is so obvious, so well recognized, that the opportunity for outsized returns just isn't there anymore?
That's the core tension.
Which brings us back to valuation. Let's restate that intrinsic value estimate from our educational DCF model.
Right. Our model suggested a range of $185 to $205 per share.
Okay. And the current share price, as we said, is $171. So concluding outlook, how do we summarize this?
Well, the current share price, $171, is trading at a discount to that estimated intrinsic value range, $185 to $205. Howmet is undeniably an exceptional quality business. Strong competitive position, rational leadership, clear growth path. But its current market valuation already reflects very high expectations. The market isn't blind to this quality.
So here's a final thought for you, the listener, to mull over. As you reflect on this deep dive, consider this. How much more potential is truly left in the tank for a company that's already performed so spectacularly? And how do you weigh its undeniable quality against a valuation that, yeah, it's below our estimated intrinsic value, but it still signals really strong market anticipation? Food for thought. All right, thank you for joining us on this deep dive into Howmet Aerospace. Our goal, as always, is just to give you a shortcut to being well-informed on these companies. And if you found this valuable, please do like and subscribe to the Stock Analytics AI channel. Remember, members get priority deep dives on all the S&P 500 stocks we're covering over the next few months. And if you want a one-off deep dive on a specific ticker you're interested in, a super thanks really helps make that happen.
And just a reminder, This analysis was generated by an AI system. It's for educational purposes only. It should definitely not be considered financial advice. Always, always conduct your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions. Knowledge is most valuable when it's understood and applied thoughtfully. And there's always more to learn. Multiple perspectives always enrich understanding.
Well said. Until next time, keep diving deep.